All right, welcome back. Today we are talking about drawing tools, indicators, and imbalances. We've kind of lumped some things together to go into the same videos to pretty much get stuff out faster. Uh, so I think we'll be like a week ahead of schedule with this. So yeah, let's get into it. Drawing tools, there's a lot of them, but there's only a select few that you need to necessarily know, most likely, that are going to be helpful for you. So let's hop on the charts and take a look at that. Okay, so first off, we're going to look at horizontal lines, which are right here. You can use horizontal lines or horizontal rays. It doesn't matter too much, but pretty much this is useful for marking out highs and lows of like just levels. Pretty straightforward. Just place it on the chart. I usually use the rays just so I can see where they began. So I'm going to mark out highs, mark out lows. Just right there, you can change the color. If you click on it, you can even write text on it if you want to. But yeah, pretty straightforward. And then this trash can in the bottom left also removes all of your drawings off your chart. And this whole interface is the same for TradingView, TradeC, and TopStepX. But on Tradeovate, it is a little different. But it still has what you'll need. So there's also vertical lines. You can use these to mark out a certain range of time if you want to, or mark out where sessions begin or end. So let's go to like right here. It's 9:30. So you can mark out um, New York market open. If you want to just get a better visual on that, New York pre-market, and so on for London and Asia. So that's just pretty much what you use vertical lines for, just marking out a certain point in time. And then let's see, we've got rectangles right here. These are useful for marking out zones, areas of interest, um, supply and demand zones, consolidation zones, and for imbalances, which we'll also talk about in a little bit. Mark out those areas. You can write on them. And also, if you go into the settings, you can turn on a middle line in case you're looking for like equilibrium or something. Um, that can be useful, or just seeing where like half of price ranges. There's your middle line. Toggle that on and off. Change the colors if you want. It's very customizable. And then you can also look at trend lines, which are right here. I don't use these super often, but they can um, help you just project where you think trend is going to go. Put it on the bottom here, and then you just kind of project. Um, Trend line is not a strategy by itself. Um, like here, it would have worked out if you marked this out and extended it and just longed all the way up here. But say if you entered here off this trend, you would get stopped out there, which would not be good. But that's just another tool to help you visualize trends and mark out here or just wherever. Uh, See where price has been going or see where you think it might go. Brush tool. It's right here. Pretty self-explanatory. You can just draw whatever you want, and you can move them around uh, for whatever you want to use that for. Uh, and then measuring tool. is also a useful one. I think it's actually called price range here. It's just a vertical arrow. You can measure like how big a move is or how big your stop loss or take profit is going to be. Just whatever. When you want to see how big a range is, super easy. You can pull this tool out and just set it to the bottom of where you want to measure and top of where you want to measure, and it will just tell you right here what the point is and what the percentage is of the market. So it's a from here to here is a 0.21% move on NASDAQ. So that's helpful. And then there's also the same thing for date range, but I've never used that. And then also super helpful right here, the position boxes. So long position and short position right here. It's helpful to place that when you've entered on a trade. So say I entered like right here. This white line in the middle is the price that I entered at and I bought, which means that profit is if price goes up, and if price goes down, that is in my risk zone. So pretty much this is your risk, the red, and your green is the reward. So it'll also show you that your target is 31 points and your stop is also 31 points. And it'll show you the ratio right here. It says risk to reward ratio is 1. Risk to reward is an important concept to learn about, but these boxes will help visualize and also just tell you what your RR is. So if I move my stop smaller, it means I'm risking less. My stop order is down here. My limit order is up here. And this is a risk to reward ratio of 3.97. That's pretty high. I mean, we've hit 1 of 4 trades before, but they're not super common. Probably don't want to be gunning for that every time. But yeah, there's long position and same thing with short position. This is my risk. This is my reward. Here's the risk reward ratio. It is 3, 1 to 3. So that's helpful. And yeah, so you'll see if you look over here, there's a lot of drawing tools, all sorts of random things. I must say the vast majority of them are probably not going to be super useful for you. Like there's all sorts of this just random stuff. Inside Pitchfork, like if this is even useful, it would be for a very niche strategy, like very specialized. Like I don't even know what this is. It's just weird. There's fib stuff. Again, very specialized tools. It shows ratios of all sorts of stuff. My favorite one is the circle. Yes. This is a great way to make your screen very colorful. The giant circle. Again, you're probably never going to find this useful. And then there's all sorts of stuff for like candle patterns, like head and shoulders. Like you see this price action, and then you know exactly where price is going to go, but like not really. This is, if it is even useful, very niche. But anyway, this handful of drawing tools are pretty straightforward, pretty easy to use. Lines and boxes, and yeah, that's all I have for drawing tools. Now let's talk about indicators. I also don't use these very much, if at all, but if you would like to use indicators, go up here, and there's a lot of them that you could take a look at or look into. Some key ones are, one of them is VWAP, which is volume weighted average price. You can see this line. It's the average price weighted by the volume of orders. Essentially, there's some uses for it. This is one of the few indicators that you might actually be able to have a profitable strategy off of, but I've never traded with it. If price is above it, like up here, then buyers are in control, or if price is below, like down here, then sellers are in control. So if you want to look into that, you can. And then you can right click to remove any indicator. Or like RSI, which is relative strength index, pops this up down here. Measures momentum, supposedly. Honestly, I never use that either. You do moving average. Another line here. Just see the moving average price, essentially, can help you see trends. But if I'm being honest, I don't really trade with indicators at all. They can be useful, but there's a lot of them. Haven't even heard of most of these. But yeah, VWAP. If you want to look into trading with any indicators, VWAP is the one I'd recommend. We know someone who trades with VWAP, and he's pretty profitable. So you can look into that. And next, let's talk about imbalances. This is a pretty important concept. It's essentially where price moves too fast for both sides, the buyers and sellers, to trade fairly. So there's a couple different types of imbalances. Let's go to the 1 hour time frame. We can see right here, here is a gap. This is from Friday to Asia Monday. You can see price closed last week right here. And then this week on Sunday or Monday in Asia, it jumped down to here. So that's what we call an imbalance. That's a new week opening gap. And pretty much there's this gap here. Take those rectangles. This gap, this is a great example of it. Essentially, price wants to fill this balance, creates an imbalance with the gap, and then price wants to come up and balance back out, and then it can continue down. This is a perfect example. Bearish new week opening gap, gap down, and then on the 3rd hour of this week, it shot up, filled the balance, and then continued down. So that is a kind of big gap, a larger imbalance. But there's also smaller ones in between days as well. So between New York session and the next London session, like right here. This didn't even create a gap, but so that's not a good example. There often aren't really meaningful gaps or new day opening gaps between the days, but between the weeks there are. This is an entire weekend right here. We go. Friday. Here's another one right here. This one's a lot smaller, but there's a little gap right there. So those are new week opening gaps. And then let's also talk about the intraday versions, which are much smaller. They're called fair value gaps. It's essentially a 3-candle confluence. Where's the brush at? So if you have candle here, it's a really bad rectangle. I'm actually just going to use rectangles. So if that's a candle body, this is a candle body, and this is the third one. And then let's see if I just draw a little wicks. Boom, 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 boom. So these ones just have tiny wicks. My drawing's not incredible, but so right here, you'll see that there's a gap. But instead of like that new week opening gap right here, there being like an actual space in between them, it's just a candle. So I'm gonna change this color. So first candle, second candle, third candle, price moved so fast up, it created a bullish fair value gap, this imbalance right here. So we can draw out that zone with a rectangle. And then here's two things that it can do. What we expect it to do often is what we call respecting it. So it will come down here, fill the imbalance, and then continue upward. That's what we often expect it to do. That's what we call respecting it, where it's pretty much the bias, or it's a bullish trend, goes up, moves so fast here, there's an imbalance. It comes back down to balance it out, essentially, and then continues back upwards. That's called respecting it. You can see that right here. This isn't a fair value gap, but it's still an imbalance, and they behave very similarly. Came up, didn't really shoot past it, and then respected it and continued bearish on this bearish gap here. The other thing it can do is disrespect it, where it doesn't continue up. So comes down here, and then instead of continuing up, it just continues down. So that means that the next candle closes below. So what you'd see is my little rectangle candles. Price could come down here and closes below. That is what we call an inverse fair value gap. So it's fair value gap and then respected continuation. But then if that fair value gap is inversed like this, that's called disrespected or invalidated. And then it is expected to go down. So disrespected continues down. And it's the same exact thing for bearish. So that's a bullish fair value gap. Do the same thing for a bearish one, where it gaps down, it moves down so fast that it creates an imbalance. We get that right here. This is a bearish fair value gap, which means it gapped down. And that same thing, but the other way around, upside down. We'd expect it to come up if it interacts with it at all, respect it, and then continue bearish. Then the exact same thing could happen where it disrespects it, and then this next candle, and it doesn't have to be the next candle like immediately after, it can be many candles later, can go down, close above. If it closes above, that means it's inversed. If it wicks out, it can still respect it. Like here, this imbalance that I keep going back to, technically it wicked above it, above the gap. If I drew a rectangle right here, here's this gap marked out. It wicked above it, but that does not mean it's inverse. For this to inverse, this candle would have had to close up here, but it didn't. So that's a respected imbalance, respected new week opening gap. So let's actually look for some of this on charts for value gaps. And you can find them across all time frames, 4 hour, 1 hour, 30 minute, 5 minute, 1 minute. I like the 5 minute. So let's just look around. Here's one right here. Look at that. Bearish for value gap right there. First candle, third candle. There's a gap between the wicks right here on this candle body. Right here. It wicked out, but it did not close out of the gap. So it respects it. And then we see a continuation down, which is literally forming right now. So you could short off that if you wanted to. This is a 5 minute fair value gap, 5 minute bearish fair value gap. Then sometimes you'll see here, it doesn't even necessarily interact with it at all on the 5 minute time frame. Doesn't even go near it, but it can later potentially. But let's go to the 15 minute time frame. Just look around, like see this giant displacement. Oh, actually, so if you see a giant displacement like this is on a 15-minute time frame. These are 15-minute candles, but it's like fair value gap there, fair value gap there. There's not one right there. But I go to the 1 hour, and that turns into one big fair value gap. So this is the 1 hour time frame. 1 hour bearish fair value gap right here. What is it? Asia session. So it comes up, and it's kind of just consolidating right now. So this isn't an amazing example, but you could expect to potentially see it break out to the downside and see a continuation, or it could still inverse it, but looks like it's kind of fizzled out now because it's just consolidating. It's just ranging, going sideways. I mean, here it is. Same thing on the 4 hour. It's a tiny gap right here. Wicks up, but it's also getting kind of choppy there. Which goes to show for value gaps are not a strategy by themselves. You got to understand like context and bias, and like overall what's going on in the market. You cannot just like see a fair value gap and execute off of it every single time. But my first 4-figure trade was off a liquidity sweep, which you will learn about soon, and a fair value gap where, I mean, I think you'll learn about this in the next video, yeah. But it came down, swept a low, came up, respected a fair value gap, and I longed off of it right there. And this was my first 4-figure trade on an eval. It was off of that continuation. And it just made its way up. So of all the candlestick confluences that you'll find for value gaps or imbalances in general are some of the most useful ones. Whereas these, I mean, you can look up candlestick patterns and you'll find a million of them, but I wouldn't really use hardly any of them. that I'd find on like the internet. But for value gaps, simple 3 candlestick pattern creates the gap. Yeah. So pretty much the fair value gaps are the smaller intraday versions, and then the new day opening gap. Often there isn't even one between the days. But then the new week opening gaps can sometimes be really big. Like I think it was in March when the war started. I think it started on a weekend. So the new week opening gap was pretty big. Just shot down. So it's like Friday closes up here. Bunch of macro news events happen, certain war, and then it just gaps down. And then it starts making its way up because it wants to fill that imbalance. So, yeah, those are imbalances, inverse fair value gaps. Yeah. Great confluence for continuation, and inverse fair value gaps can be a great confluence for reversals. But always make sure you have a good understanding of context and bias and what else is going on in the market. But yeah, I think that is all I have for now. Talked about drawing tools, indicators, and imbalances. So hopefully you guys have a good understanding of that. The next video is liquidity. So that's another super important concept to understand structure, market structure, and where price is going and why it is going where it's going. And it is a great way to catch trades, reversals. But I'll let Lucas get into that in the next video. So, yeah, see you in the next one.